Enron, the smartest guys who destroyed everything, they called themselves the smartest guys in the room. They had PhDs, MBAs, and the most sophisticated financial models Wall Street had ever seen. They turned a boring gas pipeline company into the seventh largest corporation in America. And then they watched it all evaporate in 45 days. The company was Enron, and the fraud they committed did not just destroy a company, it destroyed the retirement savings of thousands of employees, wiped out $74 billion in shareholder value, and changed the way America thinks about corporate trust forever. This is the story of how the most admired company in America turned out to be the most corrupt. Enron started as a simple company. In 1985, two gas pipeline companies merged to form Enron, based in Houston, Texas. The CEO was Kenneth, a well-connected energy executive with close ties to politicians in both parties. For the first few years, Enron was exactly what it looked like, a company that moved natural gas through pipelines, boring but profitable. But Lay had bigger ambitions. He hired a McKinsey consultant named Jeffrey Skilling, and Skilling had a radical idea. Instead of just moving gas, why not trade it? Skilling wanted to create a market for natural gas, buying and selling contracts like stocks. Enron would become the middleman for the entire energy industry. The idea worked brilliantly. Enron became the dominant energy trading company in the world. But Skilling did not stop there. He applied the same model to electricity, water, broadband, weather derivatives, and eventually anything that could be traded. By the late 1990s, Enron was not really an energy company anymore. It was a trading company that happened to own some pipelines. And the revenue numbers were staggering. In 2000, Enron reported revenues of $101 billion. It was named Fortune's most innovative company 6 years in a row. But behind the numbers, something was deeply wrong. Enron's profits were largely an illusion, built on two accounting tricks that were as clever as they were dangerous. The first trick was called mark-to-market accounting. Here is how it worked. When Enron signed a long-term deal, say a 20-year contract to deliver natural gas, they would immediately book the entire projected profit from that deal as revenue in the current quarter, not the actual cash they received, the projected future profit. This made Enron's revenue look enormous, but the actual cash was not there. Enron was booking billions in future profit while barely generating enough cash to pay its bills. It was like counting your salary for the next 20 years as money in your bank account today. The second trick was even more devious. Enron created thousands of special purpose entities, or SPEs. These were shell companies with names like LJM, Chuco, and Raptor, and they were used for one primary purpose: to hide Enron's debt off the balance sheet. Here is how it worked. When Enron had a bad investment or a failing division, they would sell it to one of these shell companies. On paper, the loss disappeared from Enron's books, but in reality, Enron still controlled these entities and was still on the hook for the losses. They were essentially hiding debt from investors by moving it to companies they secretly controlled. The man running many of these shell companies was Andrew Fastow, Enron's CFO, and he was not just hiding Enron's losses, he was enriching himself. Fastow personally made over $30 million from these side deals, a massive conflict of interest that the board knew about and approved. By 2001, the cracks were starting to show. Wall Street analysts began asking uncomfortable questions. How could a company with $101 billion in revenue have so little cash? Why were the financial statements so impossibly complex? What were all these mysterious partnerships? In August 2001, Jeffrey Skilling suddenly resigned as CEO after only 6 months in the job, citing personal reasons. Inside the company, employees were alarmed. Kenley tried to reassure everyone, telling staff in an all-hands meeting that the company was in great shape and encouraging them to buy more stock. Many employees did buy more stock. They poured their retirement savings into Enron shares. What they did not know was that senior executives were quietly selling millions of dollars worth of their own stock at the same time. Then, in October 2001, the dam broke. Enron reported a $618 million quarterly loss. The SEC launched an investigation, and Enron was forced to restate its financial results for the previous 4 years, admitting that it had overstated profits by nearly $600 million and had $628 million in hidden debt. The stock price, which had peaked above $90, plummeted. In November, Enron attempted a merger with Dynegy, a rival energy company, but the deal fell apart when the true scale of the debt was revealed. On December 2, 2001, Enron filed for bankruptcy. At the time, it was the largest bankruptcy in American history. 20,000 employees lost their jobs. Their retirement accounts, heavily invested in Enron stock, were wiped out. Many had lost everything. But the damage went far beyond Enron's employees and shareholders. There was something else Enron had been doing that the public did not fully understand until later. During the California energy crisis of 2000 and 2001, millions of Californians suffered rolling blackouts. Electricity prices skyrocketed, hospitals lost power, businesses shut down. The state was in crisis. At the time, people blamed poor infrastructure and deregulation, but it turned out that Enron traders were deliberately manipulating the California energy market. They used strategies with names like Death Star, Get Shorty, and Fat Boy to artificially create shortages and drive up prices. Recorded phone calls later revealed Enron traders laughing about the blackouts, joking about the money they were making while Californians sat in the dark. These tapes became some of the most damning evidence of corporate greed in American history. The manipulation cost California an estimated $40 to $45 billion. It contributed to the recall of Governor Gray Davis and reshaped energy policy across the country. The criminal investigations were massive. Andrew Fastow, the CFO who built the shell company empire, was charged with 78 counts of fraud, money laundering, and conspiracy. He cooperated with prosecutors and was sentenced to 6 years in prison. Jeffrey Skilling was convicted on 19 counts of securities fraud, conspiracy, and insider trading. He was sentenced to 24 years in federal prison, later reduced to 14 years. He was released in February 2019. Kenneth Lay was convicted on 10 counts of fraud and conspiracy in May 2006, but he never served time. In July 2006, just weeks before his sentencing, Lay died of a heart attack at the age of 64. Because he died before sentencing, his conviction was legally vacated. Arthur Andersen, the accounting firm that signed off on Enron's books, was convicted of obstruction of justice for shredding documents related to the audit. The conviction effectively destroyed the firm. 85,000 employees worldwide lost their jobs. The conviction was later overturned by the Supreme Court, but by then, the firm was already gone. The Enron scandal, together with WorldCom, led to the passage of the Sarbanes-Oxley Act, one of the most sweeping corporate accountability laws in American history. It changed auditing standards, imposed new requirements on executives, and created the Public Company Accounting Oversight Board. But for the 20,000 employees who lost their jobs and their retirement savings, the law came too late. The smartest guys in the room turned out to be the biggest fraudsters in corporate history. If this story shocked you, you are going to want to see what comes next. This channel is dedicated to exposing the biggest frauds, scams, and corporate scandals in history. Subscribe and hit the bell so you never miss an episode of The Fraud Files. And if you think Enron was delusional, wait until you hear about the woman who convinced the entire world she had invented a revolutionary blood test that could detect hundreds of diseases from a single drop of blood. That story is coming next. Video metadata title: Enron, the smartest guys who destroyed everything. Description: Enron was named America's most innovative company 6 years in a row. Behind the scenes, executives were hiding billions in debt using fake shell companies and cooking the books with mark-to-market accounting. When the truth came out, $74 billion in value vanished and 20,000 people lost their jobs. This is the full story of the biggest corporate collapse in history. #Enron, #corporate fraud, #Jeff Skilling, #Kenley, Andrew Fastow, The Fraud Files, #corporate scandal, #accounting, fraud, #documentary tags, Enron scandal, Enron documentary, Jeff Skilling, Ken Lay, Andrew Fastow, corporate fraud, accounting fraud, Enron collapse, corporate scandal, fraud documentary, The Fraud Files, Enron explained, Mark to Market, Sarbanes-Oxley, Arthur Andersen,